Good morning, everybody. Welcome to this morning's Informal Systems Seminar. It's our great pleasure to have Professor Ruslan Goyenko as our speaker. He's an associate professor of finance in the Desautels Faculty of Management at McGill. He has been at McGill since 2006, and he has held faculty appointments at the University of Toronto, Notre Dame, and he's currently visiting Yale University, Yale School of Management in the USA, obviously. So he's an expert on machine learning in asset pricing, which is what we're going to hear about today, and many other topics in finance. He's published, of course, in the top reviewed journals in the area. And he's organized conferences in the applications of machine learning and AI in asset management. He's the recipient of numerous research grants from the Social Sciences and Humanities Council of Canada, and more recently from the Autorité des marchés financiers in Quebec. He founded and is currently the scientific director of Firm Labs, that's Financial Innovations and Risk Management. So with no more ado, I'll let Ruslan get on with presenting asset pricing with attention-guided deep learning. Ruslan.
Thank you very much, Peter. And actually, thank you very much for having me over. I am extremely excited and extremely terrified. Let's start from terrified. The first time I presented in front of a computer science audience. Basically doing quite a bit of computer science and finance. So that, but about the extremely excited part is that just short story. Before I wanted to do undergrad, actually, I was seriously considering and actually was planning to do math and a computer science degree. And only in the last moment it was switched to the economics, right? So they're growing up in Ukraine. After the Berlin Wall collapsed and everything, so these new things started coming out. So I basically got excited about this markets and the economy. So that's the only thing which stopped me going into the computer science. And now about like 25 or so years, I just discovered I actually came back to it, right? So Firm Labs is essentially. You can visit us at firmlabs.ca. It's the initiative where you can do both, in one place, and you probably don't need to wait for 25 years for those who actually want to have interest in both in finance and the computer science. So this is one of the first output of this kind of initiative that I founded, and it's we soon to release in the end of summer 2 more papers. So this was the one with the deep learning. The other ones we're going to be releasing is on reinforcement learning. Let's get straight to it. What we do here. So I have 1 hour, right? It's correct?
Yes.
Yeah. So feel free to just interrupt and ask the question. It's a bit difficult on Zoom to be more interactive. But what we do here is first, the ideal initiative is still to do finance, right? But with a lot of the computer science applications. So what we do here is actually the most basic. We're looking at the most basic problem in financial economics: construct portfolio. And it's as basic as it goes in any investment class, and it's bottom-up portfolio construction. So basically have all the publicly traded stocks in the US, about 3,500 of those, common equities. And what we want to do, we want to construct the optimal portfolio with those stocks, and we're going to manage that portfolio. Okay, so that's a basic problem in finance. And the only thing is often we call it as SDF, stochastic discount factor, because it's related to the theory. But the other problem is always people run into. So when we construct those portfolios, there are always limits to arbitrage, right? So your performance often can be driven by the stocks which are difficult to trade, would be micro small cap stocks, right? Those to trade are very difficult, or short sale constraints. If you want to short sell a lot of stocks, it's also not really possible. So our really idea here is to look at whether these portfolio that we are going to construct can be really tradable from the investment perspective, like a real-time investment perspective. So that's the focus of this agenda. All right, so why machine learning? And that's we cannot not use machine learning, I think, anymore. Why? Because if 10 years ago, when the data were not quite there yet readily available, in investment class, you can just basically do everything in Excel. But and now what we've discovered and seen in recent years, that this extra information that you extract from alternative sources, like from using like NLPs, like from the text analysis or any other extra information, now we can gather more information, financial information. When you incorporate that information or merge it with the traditional data sets, those people who do that, and there are a lot of people who are doing that, they instantly get better investment decisions and better exposed performance of their portfolios. And the thing is, information is everything. And so this information enables you to make actually just a better decision, okay? So, and machine learning is just the only way to incorporate this information in a decision-making process when it comes to portfolio construction. So first, it's a lot of information that we need, and it makes a huge difference. And second is, all our models in finance so far have been relying on linear relationships. So, and machine learning here allows, it's a big argument here as well for non-linearity, right? So that's a big win as well. Okay, so I'm not gonna overview per se that the literature, but I just want to suggest first that we're not the first to embark on this challenge, because the people done it before, right? And this literature in finance, you can see it's the last couple years essentially. It just started, but it's getting published, so it gets in our top finance journals first. And the second, people have shown actually that applying machine learning to such things as a stock picking, for example, or the portfolio constructions or arbitrage strategy, hedging strategies, improves dramatically performances. So people used all kind of the approaches, from simple neural nets, from deep to shallow, to generative adversarial networks, to reinforcement learning, but a lot of it been focused on just with a lot of the PCA and alternatives for the PCA, the conditioning on the different instruments. Okay, but overall, machine learning picked up in finance literature and academic literature, and there is a lot of interest, but there is also a lot of skepticism. Okay, so what kind of skepticism is? So in the AI industry, you often hear that an unethical AI, right? So AI kind of discriminates, right? So here sort of this very similar thing. The problem came up that all these models are not really admissible from a real-time investment perspective. And why is just very similar thing, which goes about what you're experiencing by applying AI to like social networks or social data. So the same thing is here, because all these performances, which other people have shown could be achieved on the paper, actually driven by the signals which hit the problem of limits to arbitrage. So what it means it suggests you to trade in very small microcap stocks, right? Those are incredibly hard to trade, and trading costs are huge. or it suggests you to invest mostly in financially distressed firms, right? Those are inadmissible because you most likely probability to lose money are very high. So those performances are driven just by extreme extreme risks, which in a real-time investment manager cannot take. He or she not going to be allowed to take those risks, right? So what we do here is that our kind of main contribution is bringing attention to machine attention in financial data. So what we do, we create deep learning architecture which incorporates the attention layers, right? So and what we show is that with the machine attention, which makes a big difference when it comes to financial data, you can achieve the performances competitive enough and really relevant from a real-time investment perspective. Okay, so I'm gonna go to that metric soon. So, and the reason why we do and why the attention here is important is because, and I'm gonna go show later, that the big difference between computer science and the data people use in computer science and financial data is a signal to noise ratio. So if you are doing image recognition, 3D image recognition, and you're training your algorithm to recognize, well, the certain images, right? So to differentiate between a cat and a house, right? So the images are quite opposite, right? So there, the probability of achieving the highest recognition is really, really high. So that's the algorithms mostly this algorithm need trained on a different data. So when it comes to finance, the data are different because we essentially looking at the buy and a sell signal. Those signals are extremely noisy, and most of people in the finance professionals, they get them wrong, right? So the challenge here is buy or sell decision is completely different. So the signals to noise ratio is extremely low. And that's why the challenge is that how to make these algorithms actually to be able to remove the noise and extract the right signals from financial data. And that's where we propose the solution here, is that the attention does solve that problem, machine attention, okay? So, you know, I don't need to present what this attention is. Let's say we're gonna use a multi-head attention. Usually it's a part of transformers, but an all attention is basically this matrix representation. Again, I don't need to explain it in this audience, but what I just want to show this example of the quick brown fox, right? It's the embedding by attention layer. So the off-diagonal elements clearly show here that the fox is the object of the sentence, and how all other elements of the sentence come in to characterize the fox, right? So in our setting, we're not going to have a fox, but we're going to have about 112 signals, right? And we're going to need to objectify which of those 112 and multiple combination among those signals are actually contributing the best to the future portfolio performance, right? So our fox is going to be very different. Our fox is going to be 94 firm-specific characteristics for each of 3,500 overall stocks every month. So the data all of a sudden now just going to become a bit bigger than we usually see, at least in finance. And the other thing, so what kind of firm or stock characteristics we're going to be looking at? And these are examples. We use this standard data set we have with 94 characteristics every month for each stock. You can obtain it. And those characteristics are here. It's a lot of it is a balance sheet items, right? But those balance sheet items, actually, a lot of those are to approximate the future cash flows for these stocks. A lot of the price trends, like past price trends, a lot of the cash earnings. Well, earnings are always important, dividends, right? So the price trends, change in sales, growth, asset growth, debt, leverage, all these characteristics which normally an asset manager would be looking at, which is by balance sheet, whether it just bankrupt or not bankrupt, or what the future perspective of the growth. So 94 firm specific characteristics, including also like turnover, share price, and we're going to use 18 macroeconomic variables, and here they are just basically aggregated on the market level. So S&P 500 returns are going to be there, and a lot of others like default spread, right? It's important during market crash. Then dividend yield, book to market variances. A lot of like VIX is a index indicator, right? So, and there is also all others. I'm not going to spend much time on it. A little bit of finance, how we model. So all of this is to come to the what are we going to optimize, right? So what's our objective function? So our objective function relies on this earlier equation over here, right? So it's a very baseline theory. What it implies that there is the optimal portfolio, and this optimal portfolio kind of created bottom up from stocks, and it can price each stock. So normally, well, in undergrad class, we say, oh, S&P 500 is your optimal portfolio because it drives all the stocks in the market. But now we don't say it anymore because it's not just one thing. There are so many other factors that the S&P 500 is just one of quite several factors now. So, but what representation here is that your return of each stock over here is actually driven by a factor, right? Risk factor. And there is also alpha, but you cannot have alpha to last long. You can allow for possibility of short-lived alpha, but it's eventually going to decay, right? But essentially the performance is going to be driven by by the risk factors. And how we construct portfolio, just again to skip excuse me, to skip finance math, our portfolio is essentially right here, this one here. This is the tradable portfolio. So what we need to identify the weights we want to invest in each stock every month. Okay, so this is our optimization. We need to come up with optimal weights. The way we structure it, that our optimal weights here are going to be function of macro variables, and our optimal weight is going to be also a function of stock specific variables every month for each stock, and it's also going to be a function of all possible interaction between these macro variables and stock specific variables. So it's a lot of conditioning optimization, allowing also for non-linearity between those characteristics overall. And essentially what we're optimizing is, it's a minimization function, it's a loss function to come up with a optimal weight. You can think it's adequate. This is very similar to maximizing Sharpe ratio. There are many reasons. I don't have time right now to talk about why we are not maximizing the Sharpe ratio, but this is the exactly indirect way to maximize Sharpe ratio. And for those, if you're new to this, the Sharpe ratio is actually the return risk ratio. You want a highest return for the lowest risk. And essentially that's what it all is aimed to do here. Okay. Okay, now this is the part where computer science comes in, and please feel free to start asking questions. But our base model is the NBITS framework. It uses NBITS framework from Oreshkin, Karpov, Chapadas, Bangio, and it's so this model has stacks, right? So it has several stacks. We don't need several stacks. We just use one stack. Okay. And so what and what's going on in this stack? So the stack is the model itself, right? It consists here of 5 blocks. So why we keep 5 blocks only? It's just because it's the kind of implicit assumption here. We rely on 5 factors, which are going to drive the financial markets. Those 5 factors can be, it came from basically all these conclusions of empirical literature that 5-6 factors is enough to sort of describe all the risks of financial markets. So here they are going to be in 5 blocks. We did 6 blocks. I mean, we have the same performance. So it's better to keep the simplicity here. So, right, and each block has a sequential, right, structure. So unlike adversarial networks where they compete with each other, here it's quite different and easier and actually nicer architecture that so all upstream blocks gonna extract the first visible signal out there, right? So if the first signal is actually S&P, is the most important factor driving all the markets, it extracts that information and it produces partial forecast based on S&P, right? And then it produces backcast. Every block has a backcast, and the backcast is gonna go down to next downstream block, and the next downstream block gonna look at what the next signal in these data after the effect of S&P is removed, right? And for example, and now it's a volatility. It's a market volatility is an important factor for it. It extracts it, then it takes that signal and produces the forecast based on market volatility, right? And then sends the residual backcast into the next downstream block and so on, right? So the job of every other block is kind of easier because all the first layer of signal is extracted, so you don't need to identify it. You need to identify the next best signal out there, given the first was removed, and so on. So that's the advantage, right? So the advantage also is that this fits kind of like 5-factor model, what we often use in finance. And the other advantage is that you kind of can prioritize factors here, right? So because block 1 is that this is the most visible factor out there. It's just that the most market is concentrated, but there are others, right? So you can kind of rank even the factors after all here, what drives the financial market at this time. So, and then obviously the global forecast is going to be the stacked forecast of between from all of them. So this would be the base model, right? So, and what we do with this model also, so on the left here is the block, right? Each block starts with the attention layer. So it's a multi-head attention. And so all input, all these 94 characteristics first go through the attention layer, and only after it goes to the fully connected network to do the optimization and to produce a forecast and backcast, right? So attention layer is critical, and this is our basically innovation here, because it gonna make a huge difference eventually. Also, it's actually the closest analog to the how portfolio managers think. They think, right? So because think of a portfolio manager who knows what the data out there, but also her experiences taught her what are the most important variables or signals to look at, right? And given those experiences out of a lot of data, she's going to narrow on certain small set she can analyze as a human, right? And then after narrowing from big data to smart data, then she will decide on the optimal asset allocation. So attention is that layer when she narrows from big data to smart data, right? That essentially, after being trained, that's essentially what attention is supposed to do here. And then it basically simplifies the optimization job of the fully connected networks in the block after that. So that's how we kind of approached it, from the kind of to merge what machines can do to approximate what human approach to the finance. Okay, so the empirical design, if you don't have any questions here,
I have a question. If
yeah,
sorry,
yeah.
that partial forecast is like, what are you trying to forecast? Like the log returns of,
Okay, yeah.
of the stocks or something like that, or?
So the weights allocation. Okay, so just coming back to the optimization, it's we try and forecast. For example, we are in the end of January, and we want to make decision how much to invest for February, right? So what I'm forecasting the optimal weights to invest in the end of January or beginning of February to hold them through the February.
Just a question. Then these R's are the returns then, or what are these?
Oh, these are the returns, right? Because these optimal weights okay, so how we measure portfolio performance, right? Going back to this example, then I invest. So in the end of January, I have forecast optimal weights for February, right? So in the end of January, early February, I'm gonna buy portfolio, the weights into the stocks, and then I'm gonna hold it through the February. And then I'm gonna measure performance. So basically it's the weight multiplied by the return on those stocks in the end of February, right?
Yeah, but so usually, sorry to interrupt you. Usually the returns are because once you have the returns, you can just apply, like, I don't know, Markowitz portfolio problem and get the optimal weights, right? So
right. So
that's a difficult thing
yes.
to predict.
Well, that's the reason I founded FirmLab, because Markowitz doesn't work.
Yeah.
It doesn't work. And first thing we did, we tested Markowitz performance like out of sample. And actually, if you're really taking those weights and use it, you go bankrupt in the very first month of out of sample experience. Yeah. Right. So in finance industry,
but that's because you don't know how to predict, how to forecast with the returns, right? Because once you know.
Well, in a sense, the way we train it, right? So we are kind of, these weights are built in. You want to get to the optimal weights, but in a sense, you're forecasting returns here, right? Because what are the best optimal weight for this stock, which maximizes your portfolio performance, right? That it kind of gets to the return as well, right? So the only difference here, we also include diversification effect among many stocks rather than looking at individual. Okay.
Yeah, but diversification is implicit in Markowitz because you also minimize the risk, and that implies that will give you a diversified portfolio.
Yeah, but Markowitz only uses past returns.
Exactly.
And it defeats the purpose, because like the whole idea is to use all this extra zillion of signals, which Markowitz doesn't pay attention to. All right. So what we show is that if you use Markowitz, you're gonna underperform S&P. That's why that's why the passive investment is very good, because do something more, it comes with a bit more technology, right?
Okay, thank you. Sorry.
No problem. It's all good questions. That's to put into perspective that we actually what finance is doing now. We are going through kind of revolution right now, right? So people try to say it's evolution, right? But what I'm saying in my investment class, I'm saying that just Markowitz doesn't work, and no one uses it anymore, right? So that's how I start the investment class, because well, probably not the most optimal encouragement, but I try to bring attention here that it worked 20 years ago, but markets got so complex that investors became so sophisticated that you cannot use 60-year-old theory and to apply it to current markets, right? So it just cannot be done anymore. I hope my dean is not going to watch this YouTube channel. but that's why the lab is called financial innovations, because innovations come with the computer science, because that's where we need to basically come together now. So
sorry, just a small clarification question. In the optimization formula that you had on slide 12, which you had just shown, so this is just in some sense, if I'm reading this right, this is like the expected return. So you're not assuming a utility function which is concave or a risk factor or something right now?
No, it's linear.
Okay.
So the weight, it's all here, it's linear, but the way the characteristics help us identify the optimal weights, those that are obviously non-linearities, but the model is linear.
Okay, thanks.
Okay, so so that was our architecture. Okay, so the way we train it. So there's a lot of data, and the data from 1990 to 2020 monthly, and there are like about 4,000 stocks every month, every stock with 94 characteristics and macro variables, big panel. So what we do is that to train this model, you obviously need a lot of data, right? So we use for 1990 to 2004 as the first training sample. It's 180 months, right? And then we go out of sample, right? So our first out of sample prediction for the weight's gonna be for January 2005, right? So meaning in the end of December 2004, we know what we wanna buy and how much, right? So the weights. And then we're gonna invest in the beginning of January 2005, right? Hold that portfolio till the end of January, and then measure the returns. Measure the returns of this performance when the weights were invested in the beginning of the month. So this out of sample performance, because the model there is no forward looking in this. And then in January 2005, when we reach the end of it, we're gonna retrain the model. So we're gonna 180-month training window, we're gonna move to include now January 2005. We're gonna get forecast for February 2005. We're going to invest either in the end of January, beginning of February 2005, hold it for 1 month, then measure portfolio performance in the end of February 2005, and so on. Basically, overall, we're going to have 192 out of sample month here. All right. All right. Now portfolio performance. Okay. So I'm going to spend just some time here, right? So in asset management industry, first what you look at is Sharpe ratio, right? So Sharpe ratio here is to give you perspective. Sharpe ratio of S&P 500 for this exact period out of sample is 0.56, right? So from 0.56, you just gigantic jump in your Sharpe ratio. So what does it mean? It means your returns are way higher than S&P 500. How high it is? So it's 99 basis points. So it's 1% per month, right? So on average, you're getting 12% return per year. Okay, so that's one thing. So that's why there is always if you do Markowitz here, your Sharpe ratio will be negative. So Markowitz doesn't work anymore. So we don't report it. The other things are, just focusing on Sharpe ratio. So because higher return at a lower volatility. So that's basic. It's every fund, every mutual fund, pension fund, they also report Sharpe ratio at all times. And the other thing is we compare the base model without attention and the model with attention, right? And first, if you look at it, the first attention always gives you higher Sharpe ratio, and this difference, it's about 30 basis points on average. But in finance industry, it's huge. It's this difference which separates I don't know, the the small asset management company from BlackRock, right? So it's really it's very big. The other thing here is also, so that's first thing to pay attention to. The other thing is that when you use all stocks, or when then you get this high Sharpe ratio, almost 3, right? Is just, but then you start delete bottom 10% by market cap. So you delete micro cap stocks. Yeah, your performance starts getting more like into more realistic framework here. 1.25, 1. And then when you delete bottom 20%, meaning you're now trading in the stocks with a market cap about 2.5 billion at least, right? So you're only trading in large stocks, right? So your Sharpe ratio is 1, okay, with the attention, while the Sharpe ratio of S&P 500 is 0.56. So you still outperforming S&P 500 by a factor of 2. All right. So so attention does make a difference, not only getting higher Sharpe ratio, okay, but also there is also risk management statistics here, like maximum drawdown. So what the maximum drawdown is that it's the difference. So there is maximum one month loss, right? So that's how much you can lose per month. So if the markets drop, what the maximum drop you would experience over out of sample here, now out of sample from 2005 to 2020. So with the attention model, it's about 6%, which is okay. With the base model is like 11%, which is less okay, right? But the biggest thing is here, maximum drawdown. Maximum drawdown is the biggest drop between 2 consecutive monthly returns, okay? And if you're an asset manager and use base model without attention, right? And in one of the month, you experience your portfolio loses 24%, right? Your fund is gonna be disbursed and you're gonna be fired, right? So it's impossible. So, but the 10% you still can keep your job because you probably coincided with the whole market turbulence, right? So there's already huge differences. We also show you use the universe of 3,000 stocks, Russell 3,000 stocks. That's what asset managers usually use, right? And here we have something. Well, again, the attention is kind of still better. All right. So among other things, for the interest of time, I just skip because not a lot of time left. But what I was essentially trying to show on this graph is that most of the performance of the base model is driven by short position. That's the other thing we find. And if you're an asset manager, like think about pension funds or mutual funds. Mutual funds cannot even short sell, right? So but if you're an asset manager, most of your performance is driven by short position. Then it's a limit to arbitrage argument we run into. So basically, the base model you can think of is the one I showed is just like fully relying on and beats architecture. So the base model not gonna work for finance or with the financial data. The solution we propose here is the attention layer incorporated into this model. This is going to work and this is working, and that's the purpose. So what I'm going to be trying to do next is basically to show you that how it's working. So with the attention, because the base cannot be accepted by because it's going to destroy you. It will destroy your performance one day. Okay, so any questions? All right. So this is our out of sample, right? So, and these are a lot of graphs here, but essentially this is our attention portfolio, right? Attention model. And if you invest 100 and use all stocks, well, it's unrealistic to trade in all stocks, right? So, but it's kind of performance goes very high. But again, performance getting high here because you trade like microcap stocks, right? So you cannot really trade them because they're very expensive. You're going to burn a lot of just in trading costs. But what we do this when you Q10 is when you drop bottom 10, or Q20 would be the best analog to S&P 500, because here you're only trading in large stocks here. And I also have Russell 3000 stocks. And then you have here S&P and Russell indexes, right? So these are there at the bottom. You can see 08, S&P and Russell drop a lot. This is a cumulative performance. And this portfolio is actually those without microcap, small cap, they dropped less, much less. And the reason they dropped less, they anticipated, because after being trained, they learned what the signals are, the high volatility, they anticipate, they rebound. They still drop a little, but not as much as the market. And eventually here, they are converging in the end here. So if you use 3000 stocks, you still outperforming the indexes, but Q20, Q10, they converge, right? So this comparison is informative, but it's not fair. So because Q20, Q10, you have short positions, but the Russell and the S&P 500 are only long. They don't have short position. So, but we do it because it's kind of like diversification argument. So the more, if you don't want to trade in all stocks, here is a Q. So this is the Q20 portfolio, right? And if you don't want to trade only, if you don't need to short sell and you only trade in the top 20, what the model identifies % of your holdings. So your portfolio, and you have only long position, right? So the performance is driven a lot by long position, right? And the reason is that that you don't get a lot of, even what's happening here is like why Q20 kind of converges with the S&P 500, because eventually when your short position from, it's supposed to be losing money, but it starts making money here, and it's not so much diversification anymore. But the thing is, you don't have to essentially have a short position, right? So by construction, we're buying and shorting, right? But most of the performance here is driven by the long position. So here is the top 20 of the largest, if you trade only in the largest stocks. Okay, so the other things are, these are different Sharpe ratio statistics. I'll just skip them but it's actually no. So the Q20, right? So in 08, it's biannual Sharpe ratios. It's not always like that high, right? It gets high to above 2.3 during 2013, 2014, right? But during the financial crisis, it drops to 0.5, right? So that's one thing. So it's time varying, right? But it's but during financial crisis here, so the S&P 500 Sharpe ratio would be negative, right? So but it still does better than S&P. The other important thing here is that turnover, because what previously people mentioned previously, these models make you trade like first, these models make you invest like 300-500%, so meaning 5 times leverage, right? Or you're shorting like 300% of your portfolio. That's one thing. The other thing is sometimes the performance is driven when you take that much leverage. So you have to trade like your turnover is the 200%, sometimes 300%, extreme turnovers. Obviously, it's just not possible to do. So this model gives actually, we compute turnover from month to month. This is the average, right? And the turnover is admissible is 35%. So the question is, how come we have low turnover? And the answer is that because we have a lot of signals, a lot of characteristics. Even if you use Markowitz, first, what Markowitz would do, it would tell you to put the weight up to 300 at some stocks, right? And then with the Markowitz, your turnover is going to be like huge, right? So what we do differently is that we have a lot of characteristics like data. We have more data. And those data are stock characteristics, which allow you to identify the weight. That's something Markowitz doesn't do. And how these stock characteristics actually can decrease portfolio turnover. There is a theory and some empirical exercise in one of our top journals in finance. And they say like, it's actually critically important to keep turnover low while adding stocks into portfolio to consider multiple stock characteristics jointly. And the reason is that the trades require rebalancing in one stocks, but if you condition them on multiple characteristics for that stock, those trades can actually cancel out. And you don't need to rebalance that much in these particular stocks to keep your portfolio kind of like characteristics in a certain range. So it's essentially like, you can think about it like a supply chain optimization, right? So you need to, while you run supply chain optimization, you need to bring a lot of like all these characteristics around so that to kind of like optimal to optimize it, right? And the more factors you bring, the better optimization you can get. So the same is here. It's really the same here, but you apply it to the portfolio as well. So the only difference here, we are paying attention to those characteristics, right? So here is an exercise real quick. What if we have smaller data? Okay, let's use small data. So we went and we analyzed top versus bottom characteristics, right? And we picked up ex post, right? And instead we used top 20 and bottom 20, right? And we don't use all this big data, not 112, but for each stock, either top we only use to construct portfolio manage it only ex post identified top 20 and ex post identified bottom 20, and then compare those. So Sharpe ratios are different, first of all right? So now Sharpe ratios are very low. And if you use small data, right, and if you use not smart data and you don't know ex ante what the smart data are, you're really better off just holding S&P 500. That's it. Just don't do it. Also, if you use small data, you don't use big data, you're also better off holding S&P 500 because your maximum drawdown here could be half of your portfolio one day, and your maximum loss 1 month can be 25% in your portfolio. Just don't do that. So first, the performance completely different if you don't use big data, all right? Second, turnover increases dramatically as well. So if you don't use a lot of data, your turnover increased by 22%, and a lot of it is going to actually, majority of it going to be driven by short position, where it's especially costly to do, okay? So that's one thing. I'll skip the unimportant parts, just not relevant. So the variable importance, how we measure it, it's the, and that's where you can suggest if we don't do it the most efficiently. We use Simonian et al. Basically methodology, the gradient descent. Our output here is the absolute value of the gradient. Our output here is portfolio weight, right? And it's derivative of portfolio weight to the characteristic, so that we can see what the model identifies as important predictors, right? In terms of portfolio performance. So the that's what my peer finance colleagues sometimes are afraid, like they say it's a black box. It tries, so that's, it's important always to show that it's not a black box and look what the signals are important here. And among macros, just let me just summarize. We did this work, but what the model identifies as important signals is that the price trends, right? So, and that's sometimes why people say like trend, there's a trend analysis strategies, right? So price trends are kind of important, right? So you can, if you catch the trend and follow it, that you're going to benefit. But also what's important is in the market liquidity, but majority of the importance actually coming from the firm fundamentals, from balance sheet variables, and those fundamentals are responsible for future cash flow expectations, liquidity on the firm level, like cash holdings, return on firm assets on the firm level, and actually like credit and credit quality of that firm. That's what are important signals which go into the what the model identifies for portfolio constructions. All right, so the and other signals are here. Well, it's there is this factor BAB. It's a proxy for availability of funding in the markets, right? When borrowing, shorting, you need to borrow. So that's a macro factor, which is number one. So that's what arbitrage normally ARB's looking at. So can they borrow easily to short to go long, right? So that's first summary. So macro is important here because macro adds to performance quite a bit. I'm gonna skip it because I'm short on time. But what the most of fun we are having with here is the attention. So this is remember that fox black, the quick brown fox example, and the fox was this matrix, right? So off diagonal matrix. So the fox was in an objective in there. So the same thing we do, but because we have 5 blocks, that's for each block. After 10, it's been trained. We basically pull out that matrix and plot this saliency, well, the heat map to show what's important. It's hard to see here. That's why I summarized it at the top. But one thing is, so this is the last month of our sample. So after last time, the model was refit, right? And this is also not the most volatile market. So, and if you just, you can see each block looks different. Each picture looks different, right? So I don't have a lot of time, but each of this looks different, and those like variables actually not overlapping at all. So these variables can be summarized here in because upstream blocks picking up what's most important right now, and then the other upstream block, what's the second most important, and so on. So this is the summary for this. First important factor is financial liquidity trading activity. That's what it pays attention to on the level of first block in a stack. Then it's the value characteristics, whether the firm pays dividends, for example. Then the cash flow, future cash flow, that's the third block, which pays a lot of attention to. The fourth block, during normal market conditions, pay attention to macro and cash flow volatility. And now the last block is actually to the past returns, right? So price trends. So these are normal market conditions. Just for comparison, because I don't have time, this is the financial crisis. This is the prediction for September 2008 after the model has been trained, right? And these are the attention to going in September 2008. That's where these all just collapsed, right? So here, the completely different picture, completely. So first, the first block, and I only have time to summarize. So the first block here upstream is paying attention to macro variables, including S&P 500. So it doesn't care about trading activity, liquidity of the value. It just tests. And it's true because S&P 500 started plunging incredibly. The second block is past month return to make sense how much I drop from one month to another. The third looks at the price jumps and ability to weather the storm, the fundamentals of balance sheet. The fourth block, unsurprisingly, is looking at your real estate holdings of your company. And the fifth block is looking at the stock level volatility and uncertainty. So completely different representation of the signals and what's important in the market, right? So I understand I have 1 minute to go. We're
quite flexible. So please feel free to take a few more minutes.
Oh, okay. So, but basically, I started like jumping too fast into it. So if you go to, so this is the inception of the global financial crisis, right? The Great Depression, right? In a sense, so so to compare it, so here you look at the first block in a normal market conditions, December 2020, it looks at something like what's the financial liquidity of the firm, whether it's the trading activity. Here it looks at the identifies important indicators. Here is default spread, inflation, and S&P 500 returns. So now we know, like, this is the identification ex ante, right? And we actually always look at the default spread when we know that there is a crisis. So the model, learning from the previous experiences, basically knows that identifies the driving force right now in the economy, not the firm specific variable. No, it's the economy-wide default rate, right? It already anticipates bankruptcies coming in, right? It works, right? So ex post, we know, like, a lot of bankruptcies, but it anticipates it ex ante. Although on the, it says that S&P 500 now it's the global market factor. And yet, because when it crashes, you're gonna just go with it, down with it, regardless of whether you're Apple or Amazon. You cannot go against that. And also the only stock specific characteristics, because the previous example there was almost no macro variables. Here macro dominates, and volatility of liquidity, they're the only stock specific characteristics identified here. Here the everything looks different, because for block 2 it only cares past return, right? There's only one kind of like strongly visible, this dark color purple. So this is the return over the past month, right? And to compare it, in a previous example, that was the last block which cared about it. Here it's the second block cares about it, and so on. So this is again, this this is the rest is summarized here, is that you have real estate appeared in the fourth block. And as you remember, 2008 was the cause of the whole crisis, was of the real estate bubble. And then so real estate appeared as one of the driving factors. Real estate holdings by the companies was one of the driving factors about portfolio allocation going forward, right? And that's where the prices of real estate started dropping, right? The model was looking again ex ante. It did not know yet that in a month and 2 months the real estate starts crushing, right? So it identified it ex ante. So this is quite something you would hope you get if you trained it well, but it does that. It's almost like it's not a crystal ball, right? But it does what anticipates. It learned and it does it well. Okay, so the main message here is that well, there are two important messages. One message is that we in finance, we have no choice but to use machine learning. Here we use deep learning, which basically I guess we're doing AI now, but all the instruments cannot perform at all as well. And so that's first thing. So we are moving in our industry, finance industry, moving into joining with the computer science. And the other thing is here is how you build those models, because the biggest difference here, and why we have not merged yet per se, that the quality of the data, because the signal to noise ratio, computer science, the algorithms are built for quite high signal to noise ratio, right? To identify cat versus the house, right? So the signals to noise ratio are high, so you cannot just take those algorithms and just go into financial data. As I showed, if you just do that, you're going to go bankrupt. It's very risky. So what we did here is the attention here, bringing it, and it just building an architecture around it, and then it works. We actually this is the first our first model that actually show that it's scalable and it can be implemented from real investment perspective in a real time. And that's where I stop.
Great, thanks very much, Ruslan. It's